Hello and welcome to our webinar on taking stock of ESG intermediaries so far. My name is Iris Chu and I'm Director of the UCL Center for Ethics and Law. This is the research center that is bringing you the event tonight. This webinar is about ESG intermediaries. And by this, we mean the huge universe of people who are involved in the curation of ESG research, analysis, information, advice, ratings, as well as users of such service. We are interested in the roles played by ESG intermediaries because ESG information is increasingly important for a range of stakeholders, companies, their shareholders, investors, as well as society at large. Now, this area is not highly regulated at the moment, and there is also law and regulatory policy on the horizon. But we wish to take stock of what the industry sees in terms of the role of ESG intermediaries, the use of these products, as well as what issues need to be addressed with regard to both products and users. We also have a couple of academics on the panel who will reflect on the law and policy issues. This evening's panel is drawn from the industry as well as academia. We have representatives who are working in the ESG advisory industry, as well as in asset management. And we have academics who are experts in discussing this issue of ESG information standardization and the role of law and policy over this, particularly coming from the EU. The member of my center who has curated this event is Dr. Francisco de la Pena. He's Vice President of Trailstone Group, a global energy and technology portfolio company of private equity firm Riverstone Holdings. Francisco has curated this panel in order to take us through some of these critical issues, and he'll be posing critical questions to each panelist whom we'll invite a response from, and we'll also invite discussion amongst the panel for each question. Before I leave to Francisco to run the proceedings of the panel, I'll just make brief introductions of each panelist. Their full information or bios are on our website, on our event registration page. So in alphabetical order, we have Josephine Bush, who is co-founder and CEO of Sustainary Strategy Limited, a sustainable and ESG strategy advisory business. We have Ben Corris, who's part of the ESG team at Schroders, a large asset manager based in the UK. We have Dr. Matteo Gargantini, who is Assistant Professor of Business Law at the University of Genoa. We have David Simmons, who sits as an external advisor on the investment committee at Wealthify, which is part of the Aviva Group. We have Professor Michele Siri, who is Professor of Business Law at the University of Genoa and Director of the John Monnet Centre of Excellence for EU Sustainable Finance and Law. And finally, we have Luke Sussums, who leads the ESG strategy for EMEA at Jefferies and Investment Bank. So without further ado, let me hand over the proceedings to Francisco.
Thank you ever so much, Iris, for your kind introduction and for sponsoring this event, giving us the opportunity to sort of organize this panel discussion today. Indeed, I think the role of ESG intermediaries is very much increasingly in the spotlight. I think there are over 150 companies selling ESG data out there, whether we call them intermediaries, raters, rating agencies, or research providers. They're essentially providing an assessment on the ESG performance of companies based on the most relevant publicly available data, with the aim of identifying risks which are not flagged necessarily by conventional financial analysis. The main issue about the ESG data curated by these companies is that, according to some people, is the main barrier to sustainable investment, because the ESG data curated by ESG raters is effectively completely unregulated, is very subjective, is based on underlying data which is effectively very divergent, is curated on the basis of very different matrix, and ultimately leads to different type of assessments, ratings, or scores. Each of our panelists today will bring a unique perspective to help us understand whether these are real issues and how best to address them from a regulatory point of view. We have set up 5 questions. Each of these questions will be answered by a panelist, and right after the response, we will open the floor for a further discussion to press on and get into the specifics of each of those issues. It is very exciting to get multiple opinions from our panel experts today, and we hope that we will be able to help our delegates, all of you attending and joining this webinar today, to go away with key points which are very meaningful and complement either the research you are doing or the work you are doing, or the readings of academic articles and other opinions that you are conducting. My job as moderator is very limited to creating the space to ensure that we've got an enriched and collaborative conversation, making it meaningful to you. We are, though, very much reliant on your contribution. First, we would like to kindly ask you to send and post questions to the chat as they come to mind. And as we will have a 10-minute Q&A at the very end, we will be very happy to sort of raise these questions with our panelists to the extent that those questions haven't necessarily been addressed during our discussion. On the other hand, we will run 3 question polls, and it would be great if you can sort of take the time and answer those as well. We will be very keen to share our findings with you. So without further ado, let us kick off with the questions. And sometimes the questions are complicated, but let's not forget that the answers are quite simple. So let's hope that perhaps this is the case today. The first question is for Ben Corris at Schroders. Ben, you develop sustainable investments strategies for clients at Schroders. Do intermediaries really assist you in understanding ESG performance by companies? And do they help you shape those strategies?
I think, just to go back to some of the comments earlier, I think it's really important to distinguish the difference between information in terms of actual KPIs, data points that the intermediaries provide, and the ratings, which is their opinion about that information. And those are 2 very different things. And what you find is actually, if you look at, for example, comparing the count of fatalities that companies have for their employees between one provider and another, they tend to be very highly correlated. The same for carbon emissions. Lots of the raw data going into this stuff is very, very comparable between one supplier and another, with differences in coverage and data quality, obviously, but largely there's a very high correlation between the things going into the process. What you, however, find is that there's massive divergence in the opinions that those ratings providers will give you on whether or not a company is sustainable. And actually, I'd quite like to share a chart at this point. I hope you can see that now. Okay, so what we have here is a comparison between Thomson Reuters, sorry, that dates me, it's Refinitiv now, and MSCI rating, Sustainalytics and MSCI, and Sustainalytics and the Refinitiv offering. And so what you would see if you were to do an equivalent plot of the bond rating agencies is that those correlations would be very tight, way over sort of, an R squared of more than 90%. What you find here is there's basically no R squared, or in fact there's a negative R on the correlation. So what the opinions that Refinitiv are providing around the sustainability of companies is wildly different to that MSCI are providing, or or Sustainalytics are providing. And to me, this is the key point, that what I find really interesting is using the kind of the organizational critical mass that the intermediaries have in terms of providing the raw data. I'm always interested in talking to them about their raw data. What I find less useful is the ratings that they provide. And that's why we basically built our own proprietary models that help us to assess the sustainability of the entities that we're investing in, be that corporate or sovereign in nature. Because essentially building our own proprietary approach does a number of things for us. One, it means that we really understand what's going on, because actually when you see these wild divergences, it makes you realize how important it is to pay attention to your process and to understand why you're saying what you're saying. It allows us to have much higher quality conversations with our clients, because rather than saying we're holding this because of provider XYZ have rated it AAA, we're able to say, well, we quite like the fact that it's a business which is created avoided emissions because of its renewable energy. We can see that it's paying its employees above a living wage, and that that they have a better than industry emissions of carbon or NOx, SOx or VOx, which is a much higher quality conversation to have with clients that are very, very interested in this stuff and want you to evidence that you're being very thoughtful in your approach. But most importantly, what it allows us to do is to really focus on what we think is important from an investment context. And for us as investors, focus on that kind of like double materiality concept of saying, well, what's an important consideration from a sustainability perspective, but then also bring that kind of hard-nosed investment perspective to it as well, to have something that's really useful for our portfolio managers and investors, in a meaningful and sense. So I don't know if I quite answered your question, but I gave it a go.
Yeah, I mean, it really looks like what you are saying effectively is that intermediaries should definitely get credited for the KPIs that allow for that ESG performance to be assessed, to be measured, but ultimately not for the ratings, not for the scores.
Yeah, I think you should rely on them for getting the ingredients, but you need to do your own cooking.
Yeah, no, that's super helpful. Thank you. I wanted to ask a question to Josephine, if I may. I mean, effectively, it appears that some of the intermediaries, Josephine, what they do is they look at the impact of the world on companies rather than the impact of companies on the world, which one would think that, is the key here. Is it true that what investors think that intermediaries are actually doing is not necessarily what they are doing?
Yeah, good question. So I think both of those perspectives are relevant, aren't they? A company's impact on the world and the world's impact on the company. I think assessing that organizational impact, is definitely equally as important and critical to assessing risk and opportunity. It's one of the reasons TCFD has climate scenario analysis in there as part of their risk analysis. I think with the increasing incidence of catastrophic events on the rise and the likely trajectory on temperature rises, assessing physical impacts on infrastructure, supply chains and biodiversity, it's a critical part of the risk analysis. I think it's also why the central banks are driving scenario analysis to assess systemic risk, and insurance companies are refining their climate models. So I think the organizational approach to, physical and transitional risk will be a critical part of the rating analysis for ESG scoring and credit.
Thank you. David, can I ask you a quick question? I mean, you are a portfolio manager. How useful the scores, the ratings are for you? Do you really, if you look at a company and you see two very different rates, are you bothered about that? And how, if you are very, very keen on the company, how would you handle that? Thank you.
So I think that goes back to Ben's point about doing your own cooking, which is probably the best way I've heard it said. So we use the ratings, but also you'll engage with your fund managers who are also making the purchases, and you'll also look at the engagement that the companies get involved with. So the ESG data that you receive is very much a starting point. And I think it's you've got the problem where you've got, say, Disney, Exxon and Tesla, which are either seen as being amazing or terrible, depending on which rating agency you're looking at. And I think that that's really the problem. You've got the lack of consistency. And it's also, well, what part is important to your investors? Because some people will emphasize the E, some people emphasize the S, and some people emphasize the G. But I think also it's, well, how can you look at the impact those companies are having? Because people like to invest also in companies that are going to make a profit. And if you've got a company that's improving significantly in its environmental impact, then perhaps it's cutting down how much water it's using, how much energy it's using. And so obviously this year, it's allowed the companies to save a significant amount of money. Sorry, I can see Luke that wants to come in here.
Yeah, no,
I didn't mean to be forceful.
No, please.
No, I just wanted to make a comment, because the conversation is obviously around sort of double materiality and the impact that companies have on sort of ESG factors. And I think, obviously that's exceptionally important in Europe, and it's being written across European regulations. So this is definitely the direction of travel. Our point on this is that in absolutely no way should it take attention away from and a focus on the financial materiality argument, because, it's our perspective and my personal view that argument is no way won. Let's say it's not won yet. And I did read a staggering statistic today, which was that PwC just published its annual survey of boards and directors. And in it, the conclusion is that 55% see no link between ESG and financial performance, which is quite a scary statistic, and one that I will remember. So I just wanted to make the point that that argument isn't yet won, and there's a long way to go on that as well.
Thank you. Thank you. We are going to run the first question poll now. So to all our delegates, please do take the time to kindly answer that question. We will come up with, with the statistics later on. Let's move into question 2. Josephine, you are leading ESG strategies, supporting lots of companies across sector in building and executing the sustainability strategies for them. I mean, which role intermediaries play, in your view, in affecting ESG adoption by companies?
Yeah, thanks for the question. I also sit on a number of listed boards, actually, as a non-exec and chair of the ESG committee. So I have a number of perspectives in relation to this. But in answering the question, I thought I'd quickly explore the general role of intermediaries, as I see it, in the market for ESG ratings and data, because I think that's just important before assessing how they impact ESG adoption by companies. I guess there's 3 points to touch on in terms of that general role. Firstly, where intermediaries sit within the data supply chain. Secondly, the use cases for the data that they supply. And thirdly, the value proposition for that data. So if I look at the first point, where do they sit in the data supply chain? They're obviously ESG data providers are obviously a critical part of the supply chain for ESG data, particularly in an era where there's increasing demand for that data in investment decision making. And the demand and supply pressure is coming from a number of sources. You've got governments, regulators, exchanges, consumers, NGOs, corporates, financial market participants, all crying out for good quality ESG data. I think the lack of a single global standard for sustainability and ESG reporting means the data landscape is disparate, which is both an opportunity and risk for data providers. I mean, on the one hand, you've got lots of demand, but on the other, it's very confusing on what good looks like. And I think access to consistent and comparable and decision useful data is where we need to get to. And standard setters, indeed, the International Sustainable Standards Board should assist with this, but also data providers can assist with this. It's a critical role they play, sitting between supply and demand. So that's just one point. I think the second point I had was around use cases. And I think that there are 4 that I see that's probably broadly worth talking about. There's obviously the investor use case, which Ben and David were obviously commenting on. But I think the utilization of data and ratings helps with portfolio construction, obviously management and stewardship, and it's a critical part of the acquisition due diligence process and portfolio reporting. So that's an opportunity really for data providers with that increasing demand or interest in ESG investing. It's a market opportunity for intermediaries to extend their data provision and rating services to a much wider investor base. And other use cases, obviously, with the ESG raters themselves, it's informing their scorings, it's informing ratings and inclusion within ESG indices. And in a similar vein for credit rating, ESG data contributes to credit rating assessments, influencing the availability of debt and insurance, and influencing cost of capital. And I think there's another use case that you shouldn't lose sight of, important for companies, but just more broadly, is that ESG performance matters to employees as well as NGOs and governments and society at large, and definitely informs your social license to operate, helps with the development of policy and regulation, but particularly important for employees in recruitment and intention, increasingly so in the war for talent. The last point for I guess intermediaries would be the value proposition. So good quality ESG data is a highly prized commodity, and to capture a disproportionate share of that ESG data market, I think data providers will want to lead on the quality discussion and dominate as many of the use cases as possible. But it's reliable, verifiable, good quality ESG data that builds greater trust and credibility in the use cases. So that good quality data is of increasing value as we move forward. And let's not forget the analytical skills as well required to direct it towards the use cases that I've just alluded to.
I'd completely agree with that, especially the last point about the analytical cases, because I think when you're looking at it in an investment context, what becomes really interesting is when you're honing in on a particular metric and a particular way of looking at the world, and seeing if you can say something interesting about the company and about how it sits relative to its peers on things like health and safety in the workplace, whether not or innovation, or all these different things that fit within the ESG space. I think you tend to lose a huge amount of information when you roll it up to a single measure or even an E, S, and G measure, and that construct is really kind of unhelpful. From my perspective, it's much better to think about trying to measure the health of because all companies are basically just bundles of relationships, and for me it's about trying to measure the health of the relationships that the company has with all of its various stakeholders, and trying to figure out if any of those relationships are under pressure and then are likely to be renegotiated either by your counterparty or by the regulator because they step in and put you onto more adverse trading terms. And we've seen lots and lots of cases, especially in the UK, where, just to go back to the point of materiality, we've got companies like Wonga who basically were abusing their relationship with their customers by charging insane amounts of money. The regulator stepped in and basically handed them out of business. We've seen things like the fixed odds betting terminals in the high street bookies being regulated against, and huge amounts of revenue being lost from those businesses because the regulator said, we don't like what you're up to there. So for me, it's about trying to understand where those relationships have kind of become, in a sense, abusive and are going to be renegotiated, because that can't be a sustainable way of running your firm. So that profit you might be making now isn't protected by, isn't sufficiently risk managed, because inherently it's got to end at some point. And that's where I think the narrative and you've got to think about the transmission mechanism between this data and actually why is it important to my profits and losses, and how is it protecting my cash flows. So I think it's really critical to hone in on that point of the analytical component.
Thank you very much, Ben. That was very, very useful. Let me go back to Josephine. So, Josephine, what these mean for adoption by companies, and would you like to expand on?
Yeah, I mean, if I look at that corollary to the ESG data provider and raters perspective, from a company perspective, you could look at where does the company sit within the supply chain? What's the value proposition for the company? How should they understand? And I think, Ben was getting to this as well, the ESG raters methodology, and I think there's a point around active engagement, actually, which both Ben and David made a comment on prior. So, the company, where does the company sit in the data supply chain? I think in response to that increasing sort of demand from investors for good quality ESG data, companies are understandably focused themselves on gathering good quality data and using it for reporting purposes and to acquire the ESG rating. It's important for companies to get right, and the consequences of it not getting it right are very clear. And I've seen this as a priority on all of the boards I sit on as we look to ESG scorings and ratings. The data supply chain, though, effectively starts with the company. It's their data. It will be gathering it on its operational footprint, its strategic objectives, and what that means for its approach to ESG and the development of its ESG initiatives. And companies will use that data to outwardly report their approach to ESG, which will invariably meet the inward-looking approach taken by the ESG rating providers who are independently assessing ESG performance. But hopefully there's overlap and it's done in a complementary manner. I think the value proposition for companies is they are recognizing that their own raw data is so incredibly valuable in this data supply chain. And as well as for reporting purposes, they're also using that data to manage perceptions of their purpose, their strategy, and their impact. So if they're watching the market and the statistics, they will see that sustainable businesses that integrate ESG into their core performance and strategy development, it attracts lower cost of capital. And I think there are statistics that are out there that show that they outperform. Interesting what Luke was saying on that earlier. But ESG ratings assist with this because they signal to investors and financiers the approach that you're taking as a business. But of course, ESG scoring is only one channel to communicate the value of that data to stakeholders, but it's an important one. And I think smart companies will leverage this ownership of data in this sort of new data ecosystem to their advantage to develop competitive edge. But they need to work with the ESG raters to maximize that value, which I guess brings us onto them understanding the ESG raters methodology, because it can be confusing for companies to navigate the methodologies when they're seeking to maximize their ESG scoring. I think the lack of consistency in approach is down to, scope, measurement, and the weighting divergence. There's weighting divergence in those methodologies. So companies really need to understand those different methodologies if they're going to lean on them. Where is the data sourced by the raters, especially external sources, and how is it weighted and how is it used to measure performance? And I think if they understand this, they can streamline their reporting of their data and messaging accordingly to ensure that it delivers to the raters methodology, but not at the expense of focus on their own sustainability strategies and the development of their own ESG frameworks and metrics and KPIs. But one ESG rating provider's methodology may suit its profile more than another. And you saw the disbursement of approaches in Ben's first slide. But I was really pleased to hear both from David and Ben about active engagement, because I think with more dynamic assessments of companies using double materiality, etc., and different approaches, ESG performance is taking hold, and the need for active engagement to understand and explain the nuances of the business is required. And I'd really encourage companies and ESG raters to lean into that more, allowing for more flexible approaches to how companies are rated. And I think
thank you very much, Josephine. Luke, can I ask you a very quick question? From your perspective, are ESG intermediaries driving a market for invaluable data that helps decision making? What do you think?
I would say they're filling a very important data gap, that's for sure, because regulation is moving very, very quickly in Europe. And it's creating a huge demand for ESG data that otherwise wouldn't be available across such a broad range of equities and stocks, right? Now there are big question marks as to the quality of that data, the robustness and accuracy of that data. And I think some of those inconsistencies are quite concerning given the weight of importance being put on that information. But without them, I think it's also worth saying that I'm not sure how investors, asset managers would be able to meet some of their reporting requirements that are rapidly sort of arriving on their desks. So I guess in that respect, we're somewhat stuck between a rock and a hard place.
That's helpful. Let's look at the outcome of the first poll. I mean, effectively, the question was, from your perspective, what is the most suitable regulatory approach to increasing transparency and consistency in ESG ratings and raters? 75% of our delegates have supported the view that new rules inspired by the regulatory framework applicable to rating agencies, including a registration requirement, is the most suitable approach. So that's 75%, a very large majority. And then, effectively, 13% think that no specific regulation is needed, and the remaining would opt for certain regulatory approach, but more, applicable to those, similar to the one applied to financial analysts. So that's the outcome of the first poll. We are actually going to run now another one, and we will look at the results in a few minutes. Let's go to question 3. And Luke, as head of EMEA ESG and sustainable finance at Jefferies, obviously you advise on a wide range of governance issues, lots of investors. So the question I would like to raise is, from your point of view, what is the extent of raters' influence upon corporate behavior and the role of shareholders? Thank you.
Excellent. Thank you, Francisco. Yeah, I guess at the heart of this question really is the degree to which ESG ratings are really coveted by corporates. And I think the answer to that really is, certainly from the corporates that I speak to, is that they will covet these ratings if their shareholders and investors want them to, and want them to perform very strongly on these ratings. I think really it's as simple as that. There is something of a chain of command. And so, maybe we need to go to the top of that chain of command and think about, what investors are saying, and those that I speak to, on a daily basis. And in that respect, if we think that they're at the top of the tree, let's say, they really are prioritizing ESG ratings far less than in the past. In the earlier days of ESG and then SRI sort of before that, ESG ratings were much more heralded than they are today, for the breadth of issues that they cover that I think we've touched on, the breadth of companies that they cover, the functionality of those ratings, and so on. over time, I think the limitations of those ratings have become quite apparent. There are no shortage of academic papers that show similar charts to those shown by Ben, which are really powerful. And also those that show that really there is no real correlation between changes in performance or ESG ratings, performance against these ratings, and the share price or financial performance. And similarly, I guess they're criticized for a lack of focus on material issues as well, which I think so many of the panelists have touched on today. So I think investors' understanding and sophistication around the ESG issues has far surpassed the service that really is provided by ratings agencies. Really, I would say that they're very much used as a starting point, and often investors I speak to use them to screen for red flags and controversies, big alarm bells, and then on top of that they've built a methodology that is far more sophisticated based on risks and opportunities and a thorough consideration of ESG integration. I think all of that is certainly true in Europe. I think in US it's a touch different, but really I think that's the extent of it. So I guess with all of that said, one would be forgiven to think that companies are not heavily influenced by them, that they're not heavily shaped, and the disclosures that they make are not heavily influenced by intermediaries. That I think would be wrong. I think that isn't the case. Companies are still, the companies that I speak to are very preoccupied with ESG ratings, what they mean, and the score and the performance that they have, and how they appear, across those sort of platforms. And they do shape very heavily the disclosures that corporates make. They pay attention to those metrics, and they want to tick that box, and they don't want to seem sort of a laggard versus their peers. And so I think almost there's a slight disconnect, really, which is kind of interesting. And I guess will probably be addressed in the future, let's say. I think it's partly because companies are still sort of operating, and there's a lot of pressure on companies from all angles to disclose more. I think we're still operating very much under the old adage that you can only manage what you measure, and therefore we better measure as much as we can and disclose it. I think in the future, perhaps this will all look like a slightly more targeted approach and a slightly more materiality-based approach. Anyway, enough of that. So then your final part of the question just was sort of vice versa, and the degree to which shareholders impact companies. Obviously the answer is in many, many ways, and with huge influence, as has been touched on by the panelists. I think that this is one of the areas that I see greatest hope and greatest cause for optimism, because engagements from shareholders on corporates and what they expect on ESG is more strategic, it's more pointed, it's more materiality based than ever before, and I think as a result is one of the real levers for change when it comes to corporates and their business models when it comes to ESG factors. So I'll leave it there.
That's very helpful. Thank you very much. I've got a quick question for Matteo and Michele. I mean, I think it's right to say that EU law relies remarkably on the ability of shareholders to influence corporate behavior. Would you be able to share with us and the latest update on how this applies in respect to ESG? Thank you.
Yeah, thank you very much. Maybe I can take the floor here if Michele agrees.
Absolutely.
Okay, very good. So, well, actually, thanks also, Luke, for this kind of information. And it's, as academics, we always face the risk that we are a little bit looking backwards, and now learning that ESG ratings are not perhaps as important as they were in the past. I think that's something that facilitates a lot. But going back to the point, I mean, how much does EU law rely on engagement? Well, you can see some kind of reliance of this nature, especially in the benchmark system, where you see these two new ESG-based benchmarks, so the climate transition benchmark and the Paris Agreement benchmark. Well, there you see that they approach the traditional question whether one should invest based on a rather static or constant approach, meaning go for the best in class, or at least exclude the worst in class, or if you should rather look at the development. So what is the aim of the company, so that you might invest in somebody that is not really performing very well at the moment, but they have a good target and they credibly seek for that improvement. Now, if you look at the regulation on these ESG benchmarks, you see that the lawmakers in the European Union tend to differentiate depending on whether there is some engagement you can expect. So that the idea for bond benchmarks is that you should go more static, while you can be more dynamic for equity benchmarks, meaning you can invest in something that reproduces, for instance, the level of emission that you would have in the investable universe, but of course with a positive target, meaning with a credible project to improve. And the difference between this approach to bonds and to equity is justified by the lawmakers based on the fact that they expect that the shareholders will engage with the company. So actually this expectation is there in the regulation, and of course then the question is whether this is happening or not. I was happy also to hear in your last point that it is apparently happening and engagement is apparently more targeted for what I can get here. Again, I don't have first-hand empirical evidence, but there's an interesting paper by Luc Renneborg and some other colleagues published this year, and they also kind of confirm what you're saying, meaning that they notice that there is some influence by activist investors having an impact on the rating of on the ESG rating of the companies that they are investing into. What they notice, I think, is quite interesting, meaning they say, well, when they invest in companies with a low rating, with a low ESG rating, companies then tend to perform better still from the point of view of the ESG rating, so they tend to improve. The opposite apparently happens when they invest in companies which have already a very good ESG performance from the point of view of the rating, meaning that apparently these activist investors are able to spot problems that ESG rating agencies didn't manage to spot beforehand. And when they highlight them, then the ratings tend to adjust to reflect this information that they are digging out, essentially.
Thank you, Matteo. That's very useful. I wanted to ask David about his views. I mean, it's perhaps a very specific question, this one, but do let us know your thinking on this, David. Do you think that intermediaries influence companies moving into things that drive climate change, for instance? What is your experience on this?
So I think it's much more about the shareholders and the engagement. I think, you know, sort of as Luke mentioned, I do think there is a level of, you know, interest that comes from the intermediaries, and they've you know, the fact that some have given high marks and some have given low marks. But I think it's much more about the shareholders. The shareholders can appoint people. So, you know, there's again, sounds like I'm picking on Exxon, but there was the case of two very climate focused people getting appointed to the board, and you know, that was something that 5 years ago, if any of us here had suggested that, people probably would have laughed. And then it took a bit of time. That wasn't driven by the intermediaries, that was driven by shareholders who got together and did that. So I think it's of interest, but it's really the shareholders who you have to engage with, and that, you know, that tends to be the big institutions and the pension funds, the BlackRocks and the Vanguards. That's how you're going to get the change. I mean, the bad scores, as you know, as Ben has said, is problematic. But to be honest, if you're doing your own homework and you see a company has got a bad score, but actually you think it's a good company, you're probably going to be fairly happy about investing in that, and then maybe share your views on that. And I think that's the other thing, is there are people, as you said, there's hundreds of companies that put together this data, but we're all kind of dominated by the big ones and the news that you can find quite easily on on Google. So there is that kind of oligopoly of the rating agencies, but I just don't think they've got the same sort of power as they do when it comes to the bond investment side.
Thank you. Let's look at the results of the second question poll that we ran. The question is, should regulation address ESG rating methodologies? And there were four possible answers. 60% of our delegates answer yes, that this should be limited to mandating disclosure of certain information on the methodology and its assumptions. And the remaining 40%, is quite nearly even, they agree, but they say that supervisors should be able to verify that ESG ratings comply with the minimum quality standards, including unreliability of input data and robustness of assumptions. So that's where we are on our question 2. Let's move to question 4. So we are right in time. The question 4 is for David. I mean, David, you as Chief Investment Officer at Wealthify, you help effectively develop and oversee the firm's ethical investment proposition. In your view, whose needs do intermediaries serve? The investors, the companies, who?
Yeah, so I think they're obviously an information provider, and there is so much information out there, but actually it's gone from, say, 5 years ago being quite easy to access to going much more behind a paywall. So it is really serving the investment managers. And I think the thing is, the investment managers will approach this from the perspective of, well, what do my clients want excluded? What do they want included? And how do they value that? And then you actually have to have a good look at the data and be comfortable with it. Because if you are saying you're excluding certain companies, so say you're excluding a gambling company, and then the provider that you're using doesn't necessarily get down to a deep enough granularity. So say it looks at Japanese conglomerates and just says, well, these companies are not involved in anything they shouldn't be. And then it turns out that Japanese conglomerates tend to have quite broad holdings. They do actually have things in hotels. Those hotels have casinos in. So it feels like minutia, but then if you've got a client who is unhappy about that, then it's those sorts of things. So I think it's you're kind of being sandwiched in the middle. But I think ultimately the data providers are really just there as a service, and it's helping the investment managers make better decisions, hopefully, for their clients. But in a way, you're only as good as the data you rely on, and ultimately you probably should be double checking it. So when I was at Wealthify working within the investment team, I've now left, but when I was in that, we would double check a lot of the holdings to make sure that investment managers and fund managers were sticking to the exclusions that they said they were, because it wasn't always the case when you were looking at a new fund and they said they were excluding X, Y, and Z, but actually they were comprehensively excluding that. And it could be, well, we've got a tolerance on the revenues. So again, it very much depends on what your clients want, because ultimately it's their money. And if you don't do what they want, one, they're going to be quite unhappy and maybe take their money away. And two, perhaps even more concerningly, is you could get sued, and also it ruins your reputation.
Thank you. Can I ask you, Ben? I mean, obviously, if you can say your take on this question, that would be great. But I was keen to know, do you think that disagreements in ESG ratings affect the performance of a specific stock? What was your view on these two quick questions?
I don't think the ratings of ESG of any. I don't think they are particularly useful for any particular purpose other than providing, if a client wants to have some kind of a comparable measure between investment houses that they like for whatever reason, we're happy to help them out with that. I think that just the dispersion between them just demonstrates that this is not. There are so many different views that the nice thing is that you're not necessarily going to get into a crowded trade just because lots of other people are doing ESG, because it takes a market. You can have different views about it in the same way as different investors have different views about which stocks are cheap. They can have different views about which stocks are sustainable. And the important thing is, that the important thing is that people are doing this in a kind of an earnest and thoughtful way. It's fine if they get different conclusions. But this is just information about companies, and it's about trying to get a richer understanding about the companies you're investing in. It's not about everyone all believing the same thing.
Thank you. That's very much consistent with your message earlier. Michele, Matteo, what is your take on this? Whose needs intermediaries serve?
Well, maybe I can take the floor once again. I have to say this panel is working to me as an excellent impact assessment, meaning that normally from a theoretical point of view, the fear that you can read around in the literature, and you can also, hear echoed by the regulators, is that intermediaries, and in particular ESG ratings, may actually, well, by and large, of course, they serve the need of investors to manage and to deal with complex decisions. So it's a way to simplify a complex word. One way or another, we all need some sort of simplification when it comes to taking decisions, and of course, investments are no exception. But it's great to see that the attention is really high out there on the fact that one shouldn't really fall into the concerns of availability bias, meaning that the fact that you have some indicators shouldn't really lead you to follow blindly what those indicators do. And I mean, from what we are learning, that's definitely not the case. Another concern that perhaps we might mention that is pretty common, especially in the light of the experience we had with the rating agencies in the past, is that, well, one has to be careful that intermediaries do not serve the interest of regulators that might delegate too much, explicitly or implicitly, to ratings, meaning let them do the job, let them define the right to enter the market, so the market access. Michele and I ran some a little bit of an analysis on this, and we noticed that apparently looks like, at least from the point of view of the European Union, unfortunately we're not very familiar with the UK system, but we expect that this might be similar. It looks like regulators are currently not really relying too much on ESG ratings, if not at all, meaning that you don't find them mentioned, for instance, in the SFDR, so on the regulation on green products, to put it bluntly. And you see them only mentioned in the regulation on benchmark, but they are always labeled, I mean, all the references that you can make as a benchmark administrator to ESG ratings are always labeled as voluntary. So there is clearly an attention not to induce by any means this kind of excessive reliance that we might have been in the past. So apparently they are not serving, and luckily enough, the interest of regulators as well.
Thank you, Matteo. Iris, can I give you the floor?
Right, okay. Thank you, Francisco. Sorry, I just thought that what David has said, as well as earlier what Ben has said, really interests me, because we are academics, we're coming from the point of view of we don't quite actually know how important these ESG raters are, and they have big business, and the kind of insight I got from other informal conversations seems to be that they sell their ratings for quite a large sum of money, and there is a lot of profitable business in terms of ESG ratings, curating ESG ratings, as well as providing benchmarks. So as far as I'm concerned, I was really quite interested to hear that a lot of asset managers have their own proprietary methodologies, that they take the ratings as a kind of starting point, and they do their own granular dive in and their own analysis. I'm just thinking whether or not this has anything to do as well with the kind of fiduciary duties that asset managers have. In terms of fund management, is it because of the legal risk of not kind of applying your own mind or strategy to it that might, put you at risk or at legal risk of not fulfilling your fiduciary duties? Is that a concern for a not sort of non-mechanistic reliance on any ESG raters?
No, I think I can speak to this fairly kind of directly because, like, before I was in working centrally in ESG, I was a quantitative portfolio manager for a decade and a half here at Schroders. I have sat on the other side of the table with clients where we've underperformed, which is going to happen if you stay in asset management for a decade and a half. And you have to be able to explain really clearly what went wrong, the decisions you made, why it was the right decision at the time based on sound reasoning and logic, and look them in the eyes and explain it. If you are just using ratings, you cannot do that because you've outsourced a really important part of the consideration. So I think it's not even necessarily the fiduciary duty. I think it's like you've got to like, it is literally the job to think about this properly. And if you're not doing that, then you're not doing the job, quite frankly. The other thing I would say is actually there's lots of ETFs now that purport to be ESG that use the rating agencies. And I won't go into names of competitors and things like that because I'm about to lay into them a bit. But I think there is if we're on the subject of like fiduciary duty and things like that, I think there's a real agency problem because there are a whole bunch of things that are marketed as passive and they are marketed as indexes, but they have a whole bunch of very, very active bets against what might be considered to be the default indices. So you'll be able to buy global ESG passive things at a relatively low fee. And the company that you buy that from are implementing a passive strategy to what is effectively an active strategy that's published by someone else, but they're only talking about the performance relative to the benchmark, which should basically be zero track, right? So who owns those active bets? Who owns that performance versus what would be considered a standard benchmark? Because it's not the company you're employing to be your portfolio manager, and the people producing those ESG benchmarks are never on the hook for the performance because they don't actually face the clients whose money are being run. So I think there's a real agency problem actually when you for the managers who are out there using third-party ratings as they're kind of like the key part of their sustainability measure. Who owns the performance? Like because for good or ill, it's this is people's pension funds. This is that we're talking about a lot largely. So I think it's something you need to take really seriously, and it's more about wanting to do a good job rather than anything else.
Yeah, I think the only thing I could add to that would be it's very much trust but verify. I think what Ben has said, and I think it's also when you are talking about the underperformance. This year there's been clients who are upset, but if you look at say the S&P 500, the only sector that's up in any great shape or form is obviously energy, and it's up about 50%. If you've got a strategy that is excluding fossil fuels, you unfortunately have had the best performing sector left out, and that's a problem. But if you've told them that you're going to exclude that, that's the rules of the game. And so you have to say that, and you say, well, this is why I'm below the benchmark. If we added that back in, which you can do quite easily mathematically, this is where we would be. But you told us you didn't want that, and those are the sort of conversations that you have, and you've trusted us to do something, and we've done it. And I think that's that's the only time you can underperform and probably be okay with it.
Thank you, David. We are going to run the last question poll now. So please, delegates, take the time to answer that last question for us. We are now going to jump onto question 5, and Michele and Matteo are actually leading Cogent research on ESG at the University of Genoa. So we want to ask them effectively if they think that more standardization is actually required. Of course, ESG the closest. So the floor is yours, Michele, Matteo, on this one.
Thank you. I'm sorry, Press, I am the only one displaying slides, but so I will try to spare you a death by PowerPoint, but well, still better than nothing, perhaps. Okay, so actually, we are wondering a bit these days with Michele whether we need more standardization around ESG requirements, and in particular throughout the entire information chain. And of course, this is a difficult question to answer, because to some extent we feel like we would need to speak the same language, and we would need all the different components of the information chain to speak the same language. But we also understand that the risk of regulatory failures can be particularly high, meaning that if you go too far along that way and you make mistakes, then the systemic effect of those mistakes can be relevant. So we may start perhaps with an overall assessment of where we are standing, and of course the relevant components of this chain are, of course, you start from the raw data. We have been hearing about them already. Then about the qualification of the assets of the investee companies as green or non-green. Then you move up to the corporate reporting. That's the question also on the nature of the materiality, and then the information intermediaries step in by using this information to produce ESG ratings, and this might be used either directly by investors, as we've seen, or they might be a component of ESG benchmarks. Sometimes ESG benchmarks administrators might be ESG rating agencies, and then you see also this kind of assessment reflected into the financial products. So what about the EU law in this regard? Again, unfortunately we only focus on the EU law. Might still be relevant for the audience because of this attitude of the European Union of becoming a sort of a regulatory superpower. I'm not sure that's the right approach, in particular when it comes to the disclosure of companies, but okay. Where do we stand? Well, we feel that some very good progresses have been made from the point of view of the greenness of assets, particularly to the taxonomy regulation. ESG benchmarks are also quite advanced in that regard, if only because ESG ratings would qualify as ESG as benchmarks already according to the under the pre-existing European law. So there was no need back then to expand the scope of application of EU law in that regard. The only need was to fine-tune the old rules in the light of the new needs. And actually, the European rules on benchmarks are also taking care to some extent of the quality of the input data by the data providers. So this might also have some positive impacts on the quality of the raw data throughout the entire chain. Of course, that's not no panacea, as they say, but something good can come out of that. There is also standardization concerning the benchmarks themselves, so that the European Union decided to create, by the moment, only two, but apparently others may come in the future, 2 labels for benchmarks that satisfy some minimum level of quality. And that's a typical case of asymmetric information, which you address by setting minimum quality standards. The EU Paris aligned benchmark, which is more ambition, and the EU climate transition benchmark, which is a little bit less ambition in terms of reduction of the carbon footprint and in terms of the exclusion. So the exclusion criteria are much tighter in the Paris aligned benchmark. They are more relaxed when it comes to the climate transition benchmark. So for instance, companies producing weapons are banned from both kinds of benchmarks, but when it comes to companies using fossil fuels, they are a no-go only for the Paris aligned benchmark, but not for the EU climate transition benchmark. And also there is quite some standardization at the level of the financial product, the SFDR, so the Sustainable Finance Disclosure Regulation is also standardizing to some extent the kind of information that should be produced. There are in the annex to the level 2 regulation, you will find the templates that market participants will have to use, and they vary depending on the products that you're selling, whether it is a light green product, meaning an investment product that is essentially taking into account ESG considerations, or is a dark green product, so the Article 9 products, meaning products that have actually ESG consideration as their objective. Where we are still lacking a sufficient level of standardization, in our opinion, is, well, we have heard already about the lack of standardization on the ESG rating methodology. We get back to that in the next slide. But also when it comes to the corporate disclosure, well, by the moment, the adoption on the CSRD is still pending. The point here is that this concern that we have perhaps too many disclosure standards is not really going to be addressed, because apparently, again, in line with this idea of becoming the regulatory superpower, the European Union is kind of going its own way through the EFRAG. Not very clear how they will coordinate with the other major initiatives that are being carried out there, and in particular by the IFRS Foundation on the very same matter. The hope is that they will align to some extent. They promise to liaise with the other standard makers, but whether this will be the case or not remains a little bit an open question mark. And the point is that in many cases, if you like some standardization, at least at the minimum level in some elements of the chain, then this might affect the entire investment chain. So information chain, sorry. Then very quickly, we have already heard about the fact that the methodologies are sometimes delivering different results. We have heard that the literature is already broad about that. And actually, some scholars, but that's really a minority, tend to believe that the lack of correlation might only mean that the methodologies used are different, and that perhaps ESG ratings are measuring different things, but that doesn't necessarily mean that the robustness of their methodology is weak. But I would say the largest part of the economic literature in this sense tends to believe that we have an issue also when it comes to the reliability of those methodologies and or on the input data that ESG ratings are using. So much so that sometimes there is even some lack of understanding apparent and reportedly also among investors concerning what ESG ratings are actually measuring. So if they are risk ratings, and the bulk of ESG ratings is about this, or if they are impact ratings, so they are just measuring the footprint. So there is perhaps some need for clarifications also there. So on the basis of this very broad analysis, we are still reflecting with Michele. Perhaps there are things we can be sufficiently confident about, we might do. So some more standardization on the disclosure concerning the methodology of ESG ratings, and a little bit also about the conflict of interest. Apparently, some issues are reported there. I've seen before a question in the chat that was referring exactly to this point. And actually, according to some surveys, there are some concerns coming from the fact that the same ESG rating agencies are providing advisory services on the one hand, and also then providing ratings on the other hand. Classical case of a conflict of interest. Maybe some standardization of the conduct of business rules might also be considered. Well, here the situation gets a little bit more difficult, as I have seen from the poll, most participants in the roundtable, whether in the panel or in the audience, would agree that we should go for a set of rules that mirror more closely those of credit rating agencies. Michele and I are a little bit more skeptical in this regard. We wonder whether, just for instance, just by giving a registration, you wouldn't actually increase, just because of that, the reliance of the market on methodologies that might not be really reliable even after this kind of intervention we are considering. So we would also include the rules on financial analysts as a possible alternative, let's say, compared to sticking more closely to the regulation of credit rating agencies. Thank you very much.
Thank you, Matteo.
Matteo, sorry, if I may add just a few words. I would also share a conclusion. I think we think also that innovation and competition can be beneficial to markets and investors, and so the diversity of views, independent methodologies, subjective judgment could be useful also in this transitional phase. In time, industry and regulators' efforts to standardize the spectrum of ESG data and improve disclosure will help make rating more comparable, and perhaps the result could be more correlation in ESG rating. So at the time, investors should appreciate that divergence in ESG rating also signals a diversity of view, and that's never a bad thing. So competition could be beneficial, and you cannot rely a lot on only on regulation.
I'm not sure we can rely on standardization of data driving convergence in the ratings, because there's already quite a lot of, fundamentally, if you're measuring carbon emissions, then you're probably getting your data ultimately from CDP, for example. So there are already lots of the data is kind of, the ratings agencies are using the same data, but they're interpreting it differently. And the reasons they're interpreting it differently is because the boundary around what is ESG and what isn't ESG can be different. So while one rating agency might consider, I don't know, R&D to sales a financial measure, another one might consider it a measure of innovation, and therefore part of like the social kind of construct. So if something in or out of the boundary is sort of one consideration, there's another consideration around, even if everyone's got exactly the same things in there, they can weight those different measures in completely different ways and have completely different opinions about what's important. There's also, and I've not even finished, there's more to come. There's also the idea about actually, what do you do? Do you normalize according to sector? Do you normalize according to geography? Who are you comparing against? When you're doing cross-sectional analysis, are you doing it globally with all the companies, or are you just looking at the companies in a particular geographical area, or involved in a particular line of business, or some combination of the three? There's what you do about missing data, and can be absolutely crucial. And what a lot of agencies will do is they will treat non-disclosure as the worst possible thing you can do, which then actually has a massive bias against smaller companies that don't have the resources that larger companies do. So actually, we do something a little bit more nuanced, so that we can say sensible things, across the cap spectrum. And so there are all these decisions that are judgment calls, and none of them are necessarily right or wrong. It's very much to do with what it is you're trying to do, and what it is you're trying to achieve, and what it is you're trying to measure. And that's why I think you've got to build your own stuff, because if you're building your own stuff, you can be very, very clear. What is it I'm trying to measure, and have a big discipline around all your decisions feeding into that. So I don't necessarily know if divergence can be expected, or even if it could be, even if it's desirable, to be honest, because I think it's a great thing having lots of different opinions in the market, and trades not getting crowded. What I would say, though, on the topic of corporate disclosure and within the European regulation, at the moment, the principal adverse harm stuff that's come through, where asset managers have to now start disclosing how their portfolios are positioned, has been done in the wrong order, because asset managers now have to disclose this data, but the companies themselves that we're invested in don't have to disclose the data. So there's a massive problem here in terms of coverage. Like the gender pay gap, for example, is only really disclosed in the UK, where it's it's mandatory, but outside of the UK, hardly anyone discloses it. So I think that the focus, from my mind, the focus of the regulators should be driving better and more complete disclosure at a corporate level. And actually, maybe it's the exchanges which would be lobbying, rather than the sort of the regulators to get a more comprehensive and comparable set of disclosures about actual facts about companies, rather than expecting the opinions about those facts to converge. I think it's a much more interesting world where they don't.
Thank you, Ben. One quick question for Josephine. I mean, do you think that if we look at the midterm, Josephine, do you think that standardization could lead to the disappearance or the irrelevance of, ESG intermediaries? What's your view on this?
Yeah, I mean, I think that it would definitely put pressure on the relevance of intermediaries. I think coupled with what good looks like, if there's consensus around what it means, what good quality data looks and feels like, and how it's disclosed. I'm thinking about this from a corporate perspective. I think that puts pressure on the relevance of ratings, etc. And that, I think that aligns with some of what Ben was saying. I also think it's interesting to see what third-party auditing of non-financial data will do within this space, because I think when you've got that and you've got a level of assurance over non-financial reporting, then the trust in the quality of the data and provenance of the data will help organizations. Well, the data will start to speak for itself, and there'll be an element that there'll be trust and credibility that can be relied on for that data, and then individual investors, as Ben was alluding to, can interpret that in their own way. So you're sort of squeezing the intermediary out of the data supply chain, if you like. So
Thank you very much, Josephine.
Yeah.
Thank you. We are running out of time, so I just want to look at the results of the third question poll, which was, what is your view on the current regulation of ESG benchmarks? And 43% of our delegates today answer ESG benchmarks are useful tools, but should not be relied upon as the main or only source when selecting investments. Then last proportion, I mean 36%, said that ESG benchmarks still fail to provide clear guidance due to the opacity of their methodology and or reference to ESG ratings. So that's actually the most relevant figures that we got for the last question. We effectively have a few minutes for Q&A. I mean, there have been a number of questions raised by our delegates. I just wanted to pick up on one of them, and I open the floor. Whoever feels very keen to take it on, by all means do. The question is, do speakers have views on conflicts of interest within rating agencies? For instance, they say, between ratings and advisory divisions, or the impulse to give favorable ratings to attract users? Is any one of our panelists wants to pick up and take this one on?
I think the biggest problem actually is the agency risk. If you are, rather than the conflict of interest being the biggest problem, I think it's more that if you are a third-party rating agency and then you're publishing ratings, then other people are investing on it without necessarily doing their own thing, like we see with a lot of the ETF providers. It's that lack of ownership about the outcomes for the client that's the biggest problem, or the beneficial owners, rather than it being like an internal conflict, from my opinion.
Thank you, Ben. There's another question. I think we've got a minute for another good question. They raised the example of an oil and gas company that has a very high rating, but obviously the model can be questionable because it's an extraction industry, isn't it? And then they say, how can raters be forced to confront this through regulation? Or is this something that investors are duty bound to spot and react to?
Again, this goes down to what it is you're trying to measure, right? And so I was talking before about some ratings agency might normalize according to the whole universe of stocks, and some will do it, from what they'll describe as a best-in-class approach. So they'll be looking for the best stocks in an individual sector. So it might be a completely legitimate position to say that's the best oil and gas stock in the market. It's also a completely legitimate position to say, I'm not interested in holding oil and gas stocks because either because of the harm that they're doing to society, or I'm going to have an investment view about a transition to low carbon economy, meaning that I'm happy to take the short-term risks of energy being the best performing sector because I've got the long-term view that actually inherently there's going to be huge amounts of asset write-downs in that industry because you've got effectively unburnable carbon in the ground. All of those things are completely legitimate and defensible positions, and it's about what it is you're trying to achieve and what's important to you as an investor and your clients that are investing with you.
Thank you, Ben. I wanted to take the last few minutes because before I give the floor to our chair to close the webinar, I want to ask every one of our panelists, every one of you, to sort of, if we were to want our delegates to remember something very specific about this conversation that we've just had, what would that be? Can I start with you, Josephine? Would you like to take the lead on this question?
Yeah, I guess what I've learned and heard from all of the panelists is the need to engage be very engaged in the debate, really understand what a business is seeking to do, what its strategy and purpose is, and get underneath the skin of it in order to assess and form a view on what its ESG performance is and what the momentum behind the business is in terms of its growth objectives. So you can take a snapshot on where it is today, but look to where it's going, look at its strategic objectives, and make sure that its ESG performance is aligned to that as well. So it's about, I guess, the individual assessment of a business and positively engaging in the discussion with a business to really
Thank you very
understand.
much, Josephine. Ben, what would you say?
I'd say life's more interesting when you think for yourself.
Okay, that's very good. Thank you very much. Let's ask Luke.
Yeah, I would say that intermediaries certainly aren't a silver bullet, and everyone should remember Ben's phrase: "You can have the same ingredients, but you still need to cook." Keep that one. That's a good one.
Cool. Matteo, what would you say?
Well, this last one will be also my choice, I have to say. So I would say do not outsource too much, and don't do that in favor of intermediaries, but possibly don't do that also in favor of regulators.
David.
I think it's the data available to you really is a tool, and you need to know what you want to do with it. You shouldn't be taking the ratings as gospel, and you should be aware of the methodology that you're using if you are going to be outsourcing it even partly, and just make sure that really aligns with your values. I think if you've got that, but to be honest, it's kind of what Ben and Lucas said, everyone should be doing their own research rather than just piling in, because unless you're happy outsourcing that risk, because the rating agencies are still going to be there tomorrow, even if they make a mistake.
Thank you. Michele, would you like to say any takeaways?
Yeah, just to say that over reliance on ESG ratings is very critical. So this could be a key point for every investors, asset managers, as well as regulators.
Thank you. That was very, very useful, taking note of all that. So over to you, Iris.
Right. Thank you. Thank you to all my panelists. Thank you, Francisco, for running this panel. And I thank everybody for joining so enthusiastically and asking questions, as well as responding to the polls. I think we have a lot of takeaways this evening. I mean, I have myself gained a lot of insight into how wealth managers use ESG raters and ESG information. And this is really, truly beneficial for us working, more theoretically and academia. And the limits of what regulatory policy can do has also been well debated. And so I think we have a lot to take away in terms of thinking about what goes forward. I think there is a lot of promising developments in terms of how ESG information is being used, and we hope for more mandatory corporate reporting, and how that affects corporates, as well as how that affects shareholders, especially in terms of engagement. I think that's a very, very promising area. And in terms of law and policy, hopefully what we're doing is to facilitate more and to make more things visible as well as usable, rather than to be obstructive. So with that, I hope everyone has enjoyed the webinar tonight, and thank you all for being here. And I'll close this webinar by thanking everyone in the usual way.